Welcome to our channel. Today, we will be discussing the fundamentals of financial analysis and how to interpret financial indicators to evaluate the health of a company. Part 1. Financial Indicators. Let's start by examining the key financial indicators used in financial analysis. One of these is the P/E ratio, or price-to-earnings ratio, which gives us an idea of the relative value of a stock compared to its earnings. We will also discuss the debt ratio, which measures the amount of a company's debt relative to its equity. Other important indicators include return on equity, ROE, which measures the profitability of shareholders' investment, and many more. P/E ratio, price-to-earnings ratio. The P/E ratio measures the ratio between the market price of a stock and the earnings per share of the company. It is widely used to assess whether a stock is overvalued or undervalued in relation to its earnings. A high P/E ratio may indicate an expensive stock, while a low P/E ratio may suggest a buying opportunity. For example, if a stock has a P/E ratio of 20, it means that investors are paying 20 times the earnings to own that particular stock. Advantages. The P/E ratio provides a quick way to evaluate the relative valuation of a stock based on its earnings. It can help investors identify investment opportunities based on companies' valuations. Disadvantages. The P/E ratio alone may not be sufficient to obtain a complete assessment of the company. It is important to consider other factors such as future growth, financial strength, and the company's industry. Debt ratio. The debt ratio measures the amount of debt a company has relative to its equity. It reflects the proportion of a company's funding that comes from external creditors compared to the owners. A high debt ratio may indicate higher financial risk as the company has a higher burden of interest payments and may be more vulnerable to economic fluctuations. Advantages. The debt ratio can provide an indication of a company's financial strength and its ability to meet its financial obligations. It is an important indicator for investors looking to assess the risk associated with a company. Disadvantages. It is also important to consider the nature of the company's business and its industry. Some sectors, such as utilities, typically require higher levels of debt to finance long-term investments. Return on equity, ROE. ROE measures the profitability of shareholders' investments. It indicates the return generated by the company in relation to the equity invested by shareholders. A high ROE can be a sign of the operational efficiency and profitability of the company. Advantages. ROE helps assess a company's ability to generate profits from shareholders' equity. It is an important indicator for investors looking for profitable companies. Disadvantages. ROE alone may not provide a complete evaluation of the company's financial performance. It is advisable to consider other factors such as revenue growth, debt management, and operational efficiency. Financial indicators are useful in evaluating the financial health of a company as they provide key insights into valuation, financial strength, and profitability. However, it is important to consider financial indicators along with other factors and adopt a holistic approach when analyzing companies. Investors can use these indicators as a starting point for making informed investment decisions, but it is always advisable to consult financial experts or conduct further research before making significant financial decisions. Part 2. Interpretation of indicators. Now that we understand the financial indicators, it is essential to know how to interpret them correctly to evaluate the financial health of a company. We will discuss typical value ranges for each indicator and how to compare a company's values with industry benchmarks. This way, we can determine whether a company is financially sound or presents potential risks. P/E ratio, price-to-earnings ratio. Let's assume we are analyzing a company in the technology sector. The average P/E ratio for companies in the sector is around 25. If the company in question has a P/E ratio lower than 25, it could be considered undervalued compared to the sector. On the other hand, if its P/E ratio is higher than 25, it could be considered overvalued. It is important to also consider the company's future growth and fundamentals along with the P/E ratio to obtain a complete assessment. Debt ratio. Let's assume we are analyzing a company in the manufacturing sector. The average debt ratio for companies in the sector is 50%. If the company has a debt ratio lower than 50%, it may indicate a stronger financial position compared to the sector. However, if its debt ratio is higher than 50%, it may indicate higher financial risk. It is also important to consider the company's ability to generate cash flows to meet financial obligations. Return on equity, ROE. Let's assume we are analyzing a company in the financial services sector. The average ROE for companies in the sector is 15%. If the company has an ROE higher than 15%, it may indicate higher profitability and better operational efficiency compared to the sector. However, if its ROE is lower than 15%, it may be considered less profitable compared to its competitors. It is important to consider other factors such as revenue growth and risk management of the company. Remember, these are just examples, and value ranges can vary depending on the industry and market conditions. It is always advisable to conduct further research and compare a company's values with those of its industry counterparts to obtain an accurate assessment of its financial health. Financial analysis is a fundamental tool for evaluating the financial health of a company. Understanding and correctly interpreting financial indicators allows us to make informed decisions in the field of investments. Always remember to conduct thorough research and consult financial experts before making significant financial decisions. Thank you for watching our video on the fundamentals of financial analysis. We hope this information has been helpful to you. If you have any questions or would like to share your experiences, please leave a comment below. Don't forget to subscribe to our channel for more helpful financial content. See you soon.